A very warm welcome to you all on behalf of ICICI Securities Limited to today's webinar on Forex risk management in association with world's largest derivative exchange, NSE. So I have two questions. How many of you would like to understand different tools which will help you in Forex risk management? Please type me in the chat box. I'm parallel looking at my YouTube live. You can just type me in the chat box. Yeah, I'm just seeing the chat. Okay. Right. And my second question is, how many of you would like to learn and understand best practices and strategies in Forex risk management? Please type me in the chat box. Right. If at all your answer is me for both the questions, you are in the right webinar. My name is Ramesh Varkhedkar. I head the commodities and currencies business at ICICI Securities. We at ICICI Securities believe in continuous education and knowledge dissemination to our customers, and we keep doing these kind of webinars for all of you. In FY23, we have seen USD INR has been volatile. We saw a low of 76, high of 83, almost 9-10% of volatility, right? And today we have two distinguished guests with us. We have Sapna Ghanekar. Sapna Ghanekar is a seasoned professional in treasury and finance. She has experience of more than 25 years in banking, manufacturing, and retailing. Currently, she heads treasury at Arvind Mills, one of the largest textile manufacturers in the world. Ma'am has worked across geographies in different countries, Australia, New Zealand, China, and now in India. And her prior experience includes a long stint with French bank, Crédit Agricole at Mumbai as an interbank trader. Ma'am is a chartered accountant and has a bachelor's degree in commerce and law from University of Mumbai. So welcome, ma'am. Welcome on this webinar. We also have the second guest and a good friend of mine, Vivek. Vivek is Chief Manager, Business Development with National Stock Exchange Limited. As I said, world's largest derivative exchange. Vivek is an experienced Forex market professional with rich experience of almost 15 years and 8 years with NSE. He has worked with organizations like McLay, Phillip Capital on Forex risk management. So welcome, Vivek. So first, Vivek will run through the tools, as I said, what all corporates can use, right, to manage their foreign exchange risk. And then ma'am will move on to you to understand about the best practices or the strategies that corporate like yours uses, which will help all our customers, right? Over to you, Vivek.
Thank you, Ramesh, and thank you for inviting us for this webinar. And it was our pleasure to present on the currency derivative part, which is, one of the fastest growing asset class in India. So which is the fastest growing asset class in India right now. And in last 2 years, we have seen a significant growth in terms of futures as well as options market. So I'll just run you through this product, in quite a bit, in detail. So in which, I will show you how this market has developed over the period and how it is beneficial for the, hedgers and the general participant to cover their FX risk. Okay, I'll just share my screen over here. Yeah, so sir mentioned we are the largest stock exchange in the world. We ranked 1 in almost, this is the 4th consecutive year when we have ranked 1 in terms of number of contracts traded. The varied asset classes like equity, we have, within India, if we talk about the domestic market, we have market share of almost 93% in equity segment. When it comes to the cash, equity derivatives 100, currency futures, if I would say, in terms of notional turnover traded, we are at 62%. Options premium turnover traded terms, we are at 97%. This is the quite significant jump over 2020. We have seen the option premium turnover is the maximum growth we have seen across all the asset classes. Interest rate future also, we have a significant market share on that part. The interest rate future is again part of the currency derivative segment on the exchange. Under this NSE umbrella, we have so many, the whole financial ecosystem. When the NSE clearing corporations, and on the clearing side we have NSE clearing, which clears the domestic trade. On the IFSC side we have NSE International Exchange Clearing Corporation, and on the international exchange we have an exchange in Gift City, which is international exchange. NCDX again, NCDX and PXIL is towards the commodity and the power sector side. Index business, which is again the Cogensis on the data analytics is the part of that. The technology also we have, and this is so on. Like we have other academy which provide the market knowledge to all the investors. And also we all, everybody has seen what happens in like since 2019, how this dollar rupee has moved moved within this year. So this is a very broader picture when we can see, yes, it is on rupee is on a depreciating trend, but within this trend we can see there is a lot of volatility in between happening. So many participant or many hedgers have come in the market. Many participants have come for taking this pair as an opportunity as well. So I would not go into the depth like why it has moved and how to hedge and all this much. I'll just stick it myself to the product side. Sapna, she is more, she has the expertise in taking this thing, why it is moved and how to hedge and all. So on the product front right now, we have, on the INR front, we have major 4 currencies available. A participant come and hedge and they cover on these 4 pairs. Like we have primarily USD INR, which is the biggest contributor of the volume. So right now, overall 95% of the volume, almost 90% of the volume happening in USD INR. Apart from that, Euro INR, GBP and Yen INR are also significant pair, which are seeing a good number of volumes as well as the open interest from the participant, because we are a growing economy. Our exposures, our domestic exposures are not only limited up to USD INR. People are actually getting orders from all across the globe. So they are taking covers in all those currencies as well, using the exchange traded product. So what are the benefit? Why are they coming on the exchange over the NSE? So there are multiple reasons. Look, the primary reasons what we have just described in this slide. So basically, who are the participants? We need to understand how it is different from the bank platform. So who are the participants in OTC? When I say OTC, OTC stands for the over-the-counter market, which actually belongs to the bank side. No, so this is wherein on OTC, your only AD1 category banks are permitted to participate in interbank market. Apart from that, there's a merchant trade also possible. Like on the merchant side, like merchant and banker relationships are there, which is again part of the OTC ecosystem. When on NSE, a direct participant like FPI, banks, corporates, everybody, all other participants are permitted to participate. Individuals are also allowed to participate on exchange, wherein they may come and cover their exposures, or otherwise they can also use this product. So on the liquidity side, if you see, so basically on the bank side, it is all depends on your credit limits, how much credit limits you have or a hedger has with the bank. Here it is all depending on the margin side. So when it comes to accessibility, so bank only has multiple options, like if a bank is providing online terminal, or bank may take the orders from the client. But here we have multiple options, like you can direct interact through mobile apps. Your online trading, call and trade is also possible. Obviously, the credit exposure, when you say in the OTC market, we have seen in 2008 wherein a lot of banks are at risk. So wherein your counterparty in all the OTC trades is the bank. Here we have a clearing corporation who would be the counterparty of all the trades, wherein it comes with a settlement guarantee. So anything happens with the counterparty, so whatever happens to the counterparty, your trade is guaranteed and it will be definitely settled by the exchange. It comes with a settlement guarantee, and we have a specific corpus for that. That is called settlement guarantee fund. So so the transparency obviously is the biggest factor, to drive this market, wherein it's a very, very transparent. Like being an individual, if somebody wants to trade $1,000, or being the largest corporate, they want to trade 1,000 contracts, or say $1 million, that the price would be the same. Or say for $10 million, price would be whatever there on the screen. The participant will get that price only, irrespective of their quantity. Okay, on the bank side, we have a customized contract wherein you can go for an odd lot as well. But here you have a standard size of 1,000 USD. So that I'll take you all the contract specification. I'll take you in the next slide. So there is one more concept of MTM comes into the picture when it is traded on the exchange, because all pairs and everything is cash settled over here. So, and we do not take any kind of underlying document. So all these underlyings are being settled on with the bank. So that's why we need to take some kind of margins, as well as on the daily movement. There is a mandatory MTM settlement has to be there, that has to be settled in cash. So when it comes to the OTC market, obviously the large corporate, when I say large corporate, a person with the large exposure are obviously on a better side of the market, where because they have a large exposure to offer to the bank. Wherein here, being a price transparent, irrespective of their deal size, price will be the same. On the bank side, obviously the physical delivery, what I mentioned, and on the exchange side, it is all cash settled. So these are the contract specification for your foreign currency versus INR pairs. So for USD, Euro, and GBP, we have a pair of $1,000, 1,000 foreign currency, and in case of JPY, it is 100,000. Because it has been traded in multiple of hundreds in the price quoted in international market, so it is automatically become 100,000. The tick size stand for the minimum movement happen in the currency when it goes up or down. So that is the minimum movement. So we have a quarter of the paisa. So when I say quarter of the paisa, so 0.01 is 1 paisa, 1 INR, and the 1/4 of that paisa is the minimum tick is happening. So because of that, your bid-ask spread shrinks, the impact cost of the trade. So if you were bought and if you want to sell, so wherein, in the interbank market, generally the finance spread is around 1 paisa. Here we have a quarter to half paisa, not more than that. The trading hour, definitely currently in the current scenario since 2020 is the biggest advantage. We are, since day one, we are operational since from 9 a.m. to 5 p.m. Wherein, due to the COVID times, during the COVID times and still now, so many banks are not able to offer till 5 o'clock. So as I mentioned, like it's a standard contract. So we have 11 weekly maturities. It is unlike a OTC contract wherein you will get a specific date expiry or the contract. Here we have a set expiry. It means you can keep your contract till that date only, or you can take the nearest expiry of your actual exposure. So to give the facility, we have two kind of contracts. One is weekly, another is a monthly. So we have 11 weekly contracts and 12 monthly contracts. So when I say weekly contract, means all the contracts which are weekly expiry are expiring on Friday, and monthly contracts are expiring on your 2 working day prior to your last working day. So in that way, we have 11 serial weekly contract, and for monthly, now we are in month of say May. So May expiry is happening on 29th, and last contract which is available for trade, last monthly contract is April 2024. So this is how we cover up to 1 year exactly. So and we have two instruments called futures and options. Options basically, it's another instrument which gives you a better hedge and gives you to better opportunity in case you market moves in your favor. Okay, it works like an insurance. So in case of options, we have a strike interval of 25 paisa. For option strikes availability, we have 12 in the money, 12 out of the money, and 1 near the money strike. As I mentioned, expiries I have already mentioned. Settlement is obviously on a daily basis. As I mentioned, like MTM, it has to be settled in T+1 basis and in cash. For the final settlement, it happens in T+2 basis. And if somebody takes a position and does not, if they are not able to square up before the maturity, what will happen to that position? So that position will be automatically squared off at that day's FBL reference price. So that price is, released by FBL on a daily basis. On that specific day, on the expiry date, whatever would be the price, MTM, your contract would be cancelled, considered cancelled at that specific price. So as I mentioned, like we do not take any kind of underlying document from the client for their hedges or whatever the position they are taking. So for that, it is mandatory for us to collect some kind of margin. Now, what kind of margins we take? We all, as an exchange, we always prescribe what are the minimum margin member has to take from their client. So members are free based on their internal risk management policy. They can obviously levy some something over the exchange margin. But yes, exchange the minimum is like 1.5% is your initial margin, and plus 0.5% of your extreme loss margin. So that comes to around 2% is the minimum what exchange generally charge. Depending on the volatility, your initial margin may change. Sometimes it goes to 1.55%, also 1.6%. So all these kind of, it is all depending on the volatility. So generally it is in range of, in the current kind of scenario, it is, around 2.5% range only. So, when it comes to that is, when it comes to the notional versus margin, it is a very, very small part of your total, hedge value. So this is the framework. It is all the client level risk management framework we use. Netting of the fund, your future versus options, and like your future variable contract positions if you are running. So it will, everything would be based on the net basis. Daily MTM, in terms of your currency futures contract, it has to be settled in T+1 basis by 8:30 next morning. Margins are required. In terms of the options, the variation, it is called premium payable. It can be, again, for buy positions, it has to be paid upfront. For sell position, obviously it has to be, it will be collected, the premium variation. So the structure is as same as like the equity derivative here. So everything comes to the trading member side. So, all the clients who want to participate, they can register with themselves with the ICICI Securities, and they'll get the access of currency futures segment. So this is the final settlement, as I mentioned, until the last day. If somebody doesn't want, or somebody was not able to square up their position, they can, it will be cancelled at the FBL reference rate of that day. So this is an example of MTM, how the MTM is calculated. So basically, MTM is calculated based on a settlement price. So on the last half an hour trade, we take a value weighted average of all the trades, and based on that, we achieve to a price, and that is considered as a settlement price. Based on that, multiply by your position, and the settlement value would be considered, which would needs to be settled for that day's trade. So these are the position limit. Now, SEBI and RBI, like we in recent years, like in last 1 decade, we have seen a lot of volatility in currency segment basically. So we have seen movement from 45 to, say, we have touched almost 84 rupees. So a lot of volatility. So that's why there is a position limit concept comes in the market. So to curtail, a lot of volatility in the market. So the formula says the 6% of the open interest, or 20 million USD. In terms of USD, Anna, it is 20 million. So 20 million USD, whichever is higher is considered. So, there are dual regulator of this segment, wherein, SEBI and RBI, both the regulations comes into the picture. So as on yesterday, per client limit is the 6% is coming at 889 million USD. Any client who intend to take position on currency future, this is the maximum limit they can take. But before that, there is one more barrier called RBI guideline brings in, which is up to the $100 million. Nobody wants to do any kind of documentation. So it is kind of a pre-limit, you can assume. So up to $100 million, anybody can take. If somebody wants to go beyond $100 million, they need to do certain kind of documentation as prescribed by SEBI, that we can take it separately, and then they can go up to this limit. So on the daily basis, we release this limit. So on an average, on the lease basis, we get some around 600 million to 650 million kind of a limit. A client can easily take in terms of USD INR. So, and when it comes to the retail participation, it's very important, like how it is different for the currency Nifty futures and the currency futures, because equity futures are, many people knows, but currency is being still comparatively a newer asset class. And basically it is a product for a less, for a participant who wants to take less risk, probably a risk averse kind of thing. So this is a price comparison versus Nifty futures versus currency futures, wherein if somebody buy and sell 10 lot of Nifty and 10 lot of currency future, how much margin a person would require, and what is the cost in that way. If you see in terms of margin requirement. So on a Nifty, generally 10 to 12% kind of a margin is required, wherein for 10 lot you require around almost 10 lakh 1 lakh of rupee per lot you would require. And for currency futures, it is around 2,500 rupees. Up to that extent you would require around 2,500 rupees you would require for currency futures. So basically per lot margin requirement is quite less here, plus the cost of trade, because STT is not applicable on currency derivative, and obviously the notional value traded is much lower than the Nifty. So subsequently all of the transaction cost comes down here. So it's a very big difference in terms of the trading cost involved. So all this calculation what we have shown here, it is excluding the brokerage amount. So we do not consider the brokerage in this is all statutory charges which we consider. So obviously the transparency, low impact cost, direct access, and like being a corporate, there is many more facilities are allowed. Things are a corporate can participate over here. The structured deals for all the option what banks are offering them as a structure, it is very much possible over here. It is many corporates have suggested us like our prices are in that way is better and more transparent in terms of the pricing and the accessibility to the market and compared to the bank. Direct market access, if you see this last point, direct market access is a very wonderful facility which is allowed by the SEBI for the corporate participant, wherein it is the must thing if somebody wants to cover their hedge book or run their hedge book on a very low latency network. So for that somebody wants to do, they need to have direct market access, which is absolutely allowed for corporate. So individuals are cannot do, but yes, up to corporate level, anybody can come and take the advantage of this that market access. So this actually enables in corporate to do high-speed trading and run their own algos on the exchange. Apart from that, we also have very in-depth market information like equity. You get any participant get a full market depth, wherein a top 5 course of bids and asks are available for all the participants, wherein they can see what kind of order book is there. So it actually helps them to take the position when it comes to the larger orders. So this is the market growth we have seen in last 2 years, wherein we were in currency future terms, we were doing around 20,000 crores worth of notional turnover in before lockdown, and right now we are somewhere around 40,000 crores worth of daily turnover. Option, your open interest has also increased significantly. It has gone up multifolds since in last 3 years. Similarly, in terms of currency options, we have seen a very big jump when it is almost now standing around 3 times of pre-COVID levels. So before COVID, we were somewhere around 50 crores, and now we are doing 150 to 200 crores per day worth of premium turnover in currency options. So this is a simple representation wherein how your future and spot prices converge at the expiry. So if somebody is taking a position and keeping it till expiry, your spot would be equals to your future would be equals to your spot. So and in sometimes what happen, your bank prices are different and your exchange prices are different. So some participant who has access for both the market, that they can actually take the advantage of that position using currency futures as well. So this is from my side, Mish. Thank you. And now Sapna will take it forward for throwing a light on the risk management part.
Sure.
Thanks, Ramesh, for that introduction and this opportunity to interact with all your customers. Hello and welcome all. I'm quite happy to be here to talk to all of you about foreign exchange risk management, and perhaps also learn some of your experiences. If you can share and interact on the chat, it will also give me a good idea about your experiences. Thank you for taking the time out on a Friday afternoon. It's not easy, when we're coming to the weekend. But I'm hoping that we can make it a bit interactive so that we can all learn from each other. And if you don't feel like interacting or asking questions, that's also fine. So I'll start out by just sending out a form. And if you can just take about 30 seconds to fill that form, it will give me a good idea of what the composition of the participants are. So
Rishi, if at all, you can just paste the link of that Google Forms in YouTube chat.
It is shared.
Yeah, it's there. Thanks. Ma'am, we have approximately 43, 45 participants now.
Yeah.
So I request each one of you to click on the link and fill up the form. It's simple questions, very, very basic.
How many of us are concerned with FX rates? You can put it in the, and how many of us get up in the middle of the night or first thing, reach out our phones to just check what the market's done the previous night, what the rates are? I'm sure a lot of us, because otherwise you wouldn't be here trying to listen to this. Let me share my screen as well. So that's the form that you've been sent. If you can, it's pretty simple. Guys, you need to fill the form.
Request to participants, if at all you can fill up, it will give a fair idea.
Yeah, because then I can cover according to what your interest may be. Okay, maybe we can just start, and then I'll have a look at this in a bit just to see if people have responded. Yeah. So I'll start with my presentation. So yeah. So what is risk? If anyone wants to go and just type on the chat, because I didn't realize I wouldn't be able to see you guys. So risk, according to me, is anything that can go wrong. Yeah. If the final outcome is different from what we're expecting to happen, then that is risk, the uncertainty. And we all deal with such uncertainties or risks every single day. So let me start by giving you a very mundane example. If I have a meeting on Monday at 10:30, which is 20 kilometers away from my house, and I need to get to that meeting on time, there are many-fold risks that I may not make it on time. So there's one, that I meet with an accident, but now I'm a very safe driver. So what is the probability of that happening, right? Number two, I get stuck in traffic jam, there's a high probability of that happening. So I try to do things so that I can circumvent that risk. So I'll get up much before time and leave well ahead of time. I will ensure that there's fuel in the car. I will ensure that there's, the air is okay. I will see that the meeting's not put right in the morning so that I get caught in peak traffic. There are times when I reach the toll booth, and I'm sure a lot of you will relate to this. I will move into the lane which is the fastest. And by the time I reach the toll to pay the toll, I've realized that somebody else has moved faster than me, but it happens to all of us. So all of this is just to overcome or avoid the risk of being late. Because that's what's important to me, to reach on time for that meeting. And if by chance during my journey, if I find that the highway is clogged, I'll quickly look at Google Map and say, maybe, okay, chalo, let's take the Patli Gali so that I avoid the traffic. So I am making a decision all the time and managing my risk all the time. In the same way, we need to, if you draw a parallel to that, to the foreign exchange risk, because we're here specifically to talk about foreign exchange risk, it's very important that we understand what our risk is. Where does the risk come from? We identify the risk. Yeah, if I'm an exporter, that the money I finally receive is not equal to what I expected to receive. So if it's $1 and I thought I would get 83 rupees, the risk that it may be at 80 and I get only 80 rupees for that $1. So that's the identifying where is the risk. Yeah. So for an importer, it will be the other way around. To assess how much the risk is, for $1 or $2 or maybe $10,000, you may say it doesn't matter. But if it's 1 million and 2 million or 100 million, the scale just goes up. And say to a big corporate, maybe 25,000 is not too big, but to a small individual, 25,000 is a lot. Yeah, so you've got to identify the risk, you've got to assess the risk. And then we establish and develop strategies to how to get around that risk, how to manage that risk. And the last part is to execute or monitor those strategies and how that's doing. So the question to you and the question to think about is, do we understand the risk that is there in our activity and do we actively manage them? I would be very much interested in knowing the answers to this. If you can type out in the chat box, because that will give me a fair idea if you are a corporate or an individual, you understand it. And number two, the second question is risk management being ignored in your organization? Are you ignoring it? If so, why? That is a question I'd really be interested in knowing, because that will decide how we go ahead after this slide. I'm just going to give you maybe 10 seconds to put the answers on the chat, and I will just have a look to see if we've got any responses on the forms.
YouTube chat. There are few responses which have come on your question. Uncertainty, risk is uncertain, so on and so forth. I think.
I'd like to know whether people are managing the risk, as in they are actively, or it's just being ignored. Like, if you had a 100,000 or a 50,000 exposure over the 12 months, so 50,000 every month, and you have 300,000 at the end, what do you do with that? Do you actively manage it, or when the money comes, we just sell it, or when the payment date comes, we just pay it and we don't do any managing or in between? And if so, then why? Okay, so we're seeing here about 17, a large number of people are traders, 17% exporters, 11% importers, casual trade on currency. Okay, so quite a large portion is traders. Okay. Do you hedge your foreign currency risk? No. Yes, maybe. Do you have FX risk policy? No, because I suppose most people are traders here. What is the tenor of the hedges? Less than 1 month. Okay, hedging products use options. Okay, a lot of people are doing options and futures. Yeah, that makes sense because. Okay, I will be happy if it doesn't matter, I suppose. Yeah. Between 82 to 83, less than 82. Okay, so I think we have a perfect market here, because where dollar rupee is at the end of June, there's a whole mix of it. Everybody's there. I mean, we've got an equal share of people, some wanting it higher, some wanting it lower, some people in between, and a lot of them saying doesn't matter. I suppose those are the traders. Okay. Do we have any answers to the why is risk management ignored?
So I have one chat. I'm reading it because I'm also parallelly looking at YouTube.
Sure.
There is one from Navdeep Anand, and he says, we are a corporate, but hedging being undertaken at group level, but we are not getting properly hedged.
Okay. So it's fine if it's at a group level or it's at an individual level, that's fine. But many times what I hear is, this is the answer that I get, that why is risk management being ignored is because it's just too costly, that the costs are too high. And to that, I would like to remind you that the cost of hedging or the cost of doing risk management is far less than the cost of actually not doing it. So it's like saying, if you play a sport like a football and you just use chappals and play, or you spend the money to buy proper shoes, it's expensive to buy the shoes, but it's still cheaper than having to go to the doctor or do physiotherapy once you have an injury, right? So that's the difference, and it's important to do risk management. Now, my presentation is broadly covering from a corporate point of view, from risk management treasury. But I think for the traders in here, I will towards the end just cover a few of the of some of the points for on the option side and the and the future side. Yeah. So moving on. So first, so how do we recognize our currency exposure? So there are different ways. There are different places from where our exposure arises. So one is contracted inflows, outflows. So if you're an exporter, we may have a long-term contract, like some of the IT companies where you're giving your services. Or if you are an importer, you're buying some product and you have a purchase order, you already have the purchase order and your exposure has begun. There are times where we are actually, what I find I've seen is the marketing guys are actually in negotiation to get a contract. And they will sort of say, okay, what's the rate today? It's 83, around 83. And they're using that for pricing the product. And the negotiations may take some time, and it may close over the phone saying that, okay, this is the order mila hai. But by the time the actual contract comes or the invoice is sent out, maybe another 15 days. So there is risk there. And by the time the goods are shipped and by the time the money has come in, there's a lag between when the contract is co-closed verbally to the actual payment coming in. So it's important to know when does your risk begin or when does your exposure arise. So there's one which is contracted. The second type of exposure is when you don't have contracts, but you know that every year you do this much of business, you do this much of volume, you sell this much of a product, you export, or you buy this much chemicals, or whatever service you're purchasing or you're importing, every year this is the amount, and it may not be there at the beginning of the year, but it may happen around September, October, sometime during the year. So those are your anticipated exposure, which it will happen, but at this point in time, you don't have a contract. But then there's still, that you're going to enter into it based on your past history activity. And so there is a risk there, which you have to keep in mind, this is going to arise. The third is the exposure, which is because of the competition. So for example, for example, a corporate or an entity, which is say exporting, take an example of last year, where dollar rupee moved from 75 rupees right to 82 rupees. So at the beginning of the year, it was 75 rupees, that is April 22. And 78 at that time was the lifetime high. And, we were dying to get 78 because 78 was like superb the rate for exporters. Yeah. While importers thought, it's not going to happen. Why? We'll make the payment when we'll buy the amount when the payment has to be made. Now, when it comes to 78, if you are an exporter, we say, wow, this is great. We've not, seen this rate before. Let's hedge it. And we've hedged. But after about 2 or 3 months, say from October last year, we are in the 80 plus region. And what happens is if your competitor hasn't hedged, then you still run the risk because you are pricing your product based on the hedge that you have, but your competitor is not hedged. So he can, if for example, I price my product at 80 rupees to $1 and I'm wanting to sell my product at $1, and my competitor who hasn't sold, and he can sell his receivable at 82, he's probably going to be able to price the product at maybe 99 cents or 98 cents. And where does the customer go? Where it's cheap. So you need to be cognizant of that fact that it's not like, unless you can pass the price on to your customer and pass the, the chain, the erosion or the hit that you're taking to the customer. When you hedge, you need to be aware. You can't just hedge and forget about it, because if the competition is not doing the same thing as you, you might just lose business. And then there's there's another part of type of nature of exposure, which is like which is in your balance sheet. So if you've got foreign currency borrowing or you've got assets abroad and you need to then convert that, which is you've got to buy dollars to pay it out, or you've got to sell it to convert your receivables. So this is all the exposure, identifying and recognizing that this is the exposure that you have. Yeah. So let's just move on. Just 1 second. Let me just yeah. Now, quantifying the exposure. So once we know how to identify that this is the nature of my exposure, then we need to quantify it. So if I've got committed orders, I need to know what is the amount, what is the currency, what is the timing, when is this payment, if it's an import, when is this payment going to go out, what is the quantity, what's the currency. These are the three main things where it's contracted and committed orders. Where it's not committed, where you're doing it based on forecasts, it's very essential that we have proper MIS or information flow, so that whatever has been forecasted to take into account for our hedges or reasonable assumptions made, based on whatever the past performance are, we need to track that to make sure that the actuals are happening according to what we forecast. So to go back to my driving example, when I was driving for the meeting, I'm expecting to reach at a particular time, but if there is a traffic jam, I need to maneuver that, right? So that my actuals come in. I need to maneuver that, or I just maybe make a call saying, look, I'm going to be late. So we need to make sure that the actuals coming in are as per forecast, and then fine tune it or change it. And then the time frame. So time frame can be short term, medium term, and long term. Short term differs from what is short term, medium term, long term differs from entity to entity, individual to individual. For example, for me as a corporate, short term may be a day to a month. But for most of you traders, short term may be 5 minutes, half an hour, maybe 2 hours, max the day, right? So short term, again, depending on your trading or hedging profile, or the nature of your exposure or what you're doing, your time frames will differ. So just to go back to the guys who are traders, if your time frame is, say, 30 minutes or say hourly, and you're looking at, just doing a trade and getting out by the end of the day, it doesn't make sense for you to look at data which goes over a week, or charts that go over a week, and based on that decide, because your time frame is really, really small. So you need to know what is the time frame, what is the the period I'm looking at, and trade within or hedge within that time frame. Quantifying the risk. So once we know how much is our exposure, so suppose it is $1 million, and we know that it's in dollar rupee, and the tenor is, say, 1 month, then we need to quantify the risk in the sense that how much, if it's $1 million and the dollar rupee exchange rate moves by, say, 1%, what is my risk? So that will give you the amount of currency risk that you have, and your P&L will fluctuate accordingly. The second thing that we need to do is scenario analysis. So for example, whether it's a trader or whether it's a corporate, if you decide that you've got a position or exposure of 1 million, and you do different types of scenario analysis. So if, for example, you're a corporate, and say we've got $1 million and we are at 83 rupees. So we are an importer. So if dollar rupee has to go to 83.20, so it's going to cost me so much more. Am I able to then transfer that risk or transfer that loss into my product to my customer? The answer to that, whatever your answer to that is, will tell you how much of risk can you take. Okay. Now, for a trader, if you've taken the position and say you're short dollar rupee, and for example, in a day like today, where the last 2 days it's been pretty steady. So if you are short dollar rupee at, say, 82.70 on the May future, then you might say that, okay, if it goes, I think it's going to go down by 10 paisa. So I am hoping to make 10 paisa into, say, $500,000, which is 50,000 rupees. But what if it goes against me? So what in the scenario, if it goes against me 10 paisa, I'm going to lose 50,000. Am I okay with taking that sort of a loss? Or so that will dictate how much. You've got to think of these scenarios and say that, okay, maybe no, I'm not okay with taking 50,000 because my risk appetite is nothing. So maybe 5 paisa. So you do these scenario analysis when you're taking a hedge, or when you're taking a position, or when you're not doing it, so that, like just going back to the hedging example, if I'm an exporter and I think, let me wait because dollar rupee has been going up, and I say, okay, we might break 83, so I'll get much better. But in my mind, I need to have some sort of a scenario analysis that, look, we've touched 80 to 80 and we've come off. So if it goes below maybe 80 to 50 or 80 to 20, whatever is that level scenario, how is my P&L going to get affected? So it's important to do the scenario analysis so that you understand the risk. And the third thing is stress testing, where scenario analysis tells you where you can put your stop or your TP. Stress testing tells you the point beyond which it's going to break your back. So beyond this, I'm going to go bust. All my margins are going to get wiped out. Beyond that, I don't have the capacity to hold. I just need to exit the position. Sometimes we get on our knees and start praying, oh God, please make this come down, or please make this go out. If you're short, please make it come down. Please make it come down. And it keeps going. There has to be a point where you've got to say the pain is just too much. We need to just exit. Stress testing helps you do that. Yeah. And when you think about this, you realize for example, there are times in say the equity market where we've bought a stock because we want to make the quick money, and then it doesn't go our way. So then we all become long-term investors. I know I've had that experience, and I think if you say to me that you haven't, then I think you're lying. But if you in equities, you can hold and you become long-term investors, and then you know that, okay, that's the amount I lose. But in currency markets, you need to have that, you need to know a point at which you're going to, it's going to really hurt that bad and you need to exit. Yeah. Otherwise, you run the risk that you could damage your whole company. Now, we've seen how to identify the risk. We've seen how to quantify how much the risk. How do you manage that risk? So for corporates, now this is specifically for corporates, and for a trader, it may be a different thing. You need to have some sort of a policy framework. So the policy depends. So for the corporate, the policy depends, and for a trader, you can just bring it down to an individual. The policy depends on what is your appetite to risk, or what is the management's appetite to risk, what sort of company you are. And if it's a trader individual, what sort of how much risk can you take? Are you a punter that you can take, or you want to be, you're a salaried employee doing this on the side, just testing the waters, don't want to lose more than this much. So it's your attitude towards it, your mental framework. And number two, for a corporate, can you change your price of the product if it goes against you? So if you have wafer thin margins, then maybe not. You might want to, the moment you have an order, hedge it, because that is a prudent approach without any risk. And you know that, okay, if I have a receivable, the moment I have an order, I hedge it. I know I've locked in the rate. This is what I'm going to receive. I know my costs, and you've locked in your margins. If you're one of those type of corporates who have that sort of a product, if you're an importer, you want to lock in your cost. You've said, okay, this is my cost. Now, based on this cost, I know how to price my product. And that's a conservative approach. There are other approaches. There is no one right approach. So depending on the type of management, so you might have a treasury that is very risk averse, which is the type I spoke about. And there is, which is called like a cost center treasury. And there's the other extreme, which is a profit center, which is they hedge at will, and they're churning and booking and canceling the hedges with the objective of making a profit. And there's an in-between type of treasury, which is the value-based treasury, where you follow some sort of a policy where you say, okay, maybe 20% or 30% we hedge, come what may, we just do it at regular intervals. And then with the balance, we look for opportune moments and we do some amount of dynamic hedging, like, in and out, so that it will improve, optimize the rate. The type of treasury, as I said, will depend on the type of management. It also depends on the resources available, the costs, the systems that you have. So you've got to have the people, the expertise. You may outsource it to a consultant or a bank. You take views from a bank. You might, decide that you have in-house expertise. You have systems to monitor it. If you don't have the systems, so if for a lot of traders, you might not have expensive systems, but if you're using a platform like ICICI Securities, you have, they have the charts available. They have some sort of a news, that the news that's happening. So you have those type of thing, but the responsibility of hedging and decision lies with the treasury and the people who are the experts. Then the responsibility of forecasting and the frequency. So, forecasting how much is your exposure would lie with the particular, that would be detailed in the policy. The products that you're allowed to, the financial instruments that you're allowed to use for hedging. So, for example, us as a corporate, we do forwards, which is an OTC product. We do spot, we do cash, we do TOM, we do futures, which is on the exchange. We also do options and structured products, both OTC and on the exchange. So, but the risk that is associated with has to be recognized by the board and the top management, and it has to be detailed in the policy, that the policy allows you to be in these instruments, in these currencies, the limits that each of the person, the names of the people who are authorized to deal, the limits, their stop loss, the transaction size. Otherwise, you run a risk that it can happen that a trader has made a loss, and then you want to recover it, and then you double your position, and then you lose. I mean, you will probably relate when I say that the moment I sell, that's the low for the day, and then it's gone right up. And I'm thinking, okay, maybe now I should double and stop and reverse the position and buy, and that's the high, and it's come down. Those, in my words, are Qurbani deals. When you do those deals, you know that, okay, this is a day to give Qurbani and it's all going not right. So it's just good to just close up the book and think fresh. So that's why it's important to have limits, your stop loss, your size of the thing, of the size of the deals, and also for traders. So even for individual traders, you in your mind need to know that what is my stop? What is the amount of loss I'm okay in taking? So, depending on your risk appetite and depending on the capital that you have, you may decide that, okay, I'm okay to take $10,000 a position, or $250,000 or $500,000, and I'm okay I don't want to be taking more than a 3 paisa or 5 paisa or 10 paisa, whatever it is. But if you have those written down somewhere, it's very clear when you get tempted to see that, okay, ye to niche ja raha hai, chalo, let me just get into it and sell. It's very clear when you look at that and you decide, I want to be selling, but okay, what's the risk? How much, if it goes the other way, right from the point I'm selling, at what point am I going to say I'm wrong and cut the position? Right? And for a corporate, segregation of duties is another thing where there has to be a difference or a segregation between the front office, that is the people who do the deal, and the back office. Those are the guys who actually the confirmation goes to. So when we do, say on the exchange, you do a futures and futures deal, and for a corporate business, and I as the trader have done a deal and I saying I've sold $500,000 at XYZ rate, the contract that comes from the exchange for that or from the broker should go to my back office, so that there is a clear segregation, and if there are losses, they are not hidden. Moving on to the next thing, what are natural hedges? Natural hedges are where you have exports as well as imports. So if I have, say, 20 million of exports and I have 5 million of imports, then essentially I have a 5 million natural hedge. My net exposure is 15 million exports. Yeah, so I don't need to worry about I'm just concerned with the net amount. But one thing to remember here, even in natural hedges, is the timing of the payments. So maybe an import I have to pay in 1 month, but my export receivable may be after 6 months. So I need to be aware and alert about that. Yeah. And then it's, again, we need to differentiate between hedging deals and trading deals. So for a corporate also, we have hedging deals and we have trading deals. Excuse me. Otherwise, it can come down to, like stock market, you took the deal for trading, but it's gone against you and now it's suddenly become like a long-term investment and you don't want that. Yeah? Now coming to the instruments, spot, cash, term, they're all OTC instruments where the moment we get an inflow, like if I've got $50,000 or $100,000 coming in today, I need to sell that $100,000, deliver that $100,000 and get back the equivalent rupee. That can only be done by me doing it with my authorized dealer. So if my bank says ICICI Bank and they come back saying to me that you've received 100,000 last night, I will say, okay, can you please sell it value cash? And this is the exchange rate today. The dollar is sold by them in the market and I get a credit of rupees, whatever the rupee equivalent. Forwards is, again, if I have an import payment, say, or export, vice versa, after, say, 1 week, and I'm worried that I think dollar rupee is going to go up after a week, you know, I don't want the risk. I might say, okay, let me hedge or let me buy for value date, say 30th June, because that's my payment date. I want to buy it today and just lock and sleep well at night. So that comes under those are what we call forward. So you buy spot, plus you pay a premium, and the net rate is what you get. And again, this is an OTC product because you are going to transact with the bank through whom your payment is going to go out. Futures are on the exchange, and both corporates, individuals, traders also do that. All participate in this. And Vivek went through the exchange specifications. If I want to buy on the futures, and it's possible as a corporate, I do that as well, because as he said, sometimes right now, the OTC markets close at 3:30 and a lot of time movements happen after 3:30. I may choose to buy on the exchange. As a trader, you might want to buy or sell on the exchange. These are come under the futures and it's for a specific date. So mostly month ends, May, June, July, and on expiry, if you don't square it off, as in if you've bought and you don't sell it off, on expiry, you will have to net settle the difference. So for example, what does that mean? If I buy at 80 to 60 today, and at the end of the day, I don't sell it back, and the rate is 80 to 58, then 2 paisa is debited to my account on the futures. That's the mark-to-market debit. Tomorrow or on Monday, if it's at 80 to 70, I will get a credit back because they've debited me for 2 paisa. But the difference between 80 to 58 and 80 to 70 is what I will get credited. If I don't sell it and I keep carrying the position, then on month end or on expiry, the difference between my price that I bought it at and the expiry rate, which is equivalent to the spot rate on that date, is what will be my PNL, crystallized PNL. Yeah. And options, that's the other product, which is a plain vanilla, which is I straight away just buy a put or a call option or I sell. And so what is a put option? A put option is a right to sell. So if I feel, now this is more, I'm just talking about for people who are just trading and not going into why you would choose an option or a forward. If you thought dollar rupee was going to be going higher, 83, and you think that eventually it's going to go up in the next 1 month, you might, if you take a futures, then you are having to fund it every day. And if instead of 80, if you bought an 83 strike, okay, and it's at 82.20, you've got to, if you bought a futures at 82.60 and then it went down to 82.20, you would have taken a 40 paisa loss. But you can take an 83 strike call option. That means you have a right to buy. It's like an insurance. And you say, okay, I will, whatever is the premium. Suppose the premium is, say, 10 paisa. And you buy $1 million of option at 83, call option of 83, June expiry, 10 paisa. I'm just giving an example. I don't know what the number is. Then you will pay 10 paisa into $1 million, which is 1 lakh rupees, or say take $100,000 if you decide to do 100,000 option and you pay 10 paisa premium, it's 10,000 rupees. And you just sit with that. And at the end of June, if dollar rupee is 83.50, you made 50 paisa, but you've spent 10 paisa and you've got a net 40 paisa, right? You've got a gain. While if dollar rupee went to 82, as compared to what you were expecting 83, you've just lost the 10,000 rupees that you've paid. So it's really like an insurance where you have the protection, but you also have the upside. I mean, like if you have for an exporter or an importer where you want to just get the protection, but you also want to say that, no, what if I'm an importer, what if it comes down? I want to have the downside as well. Then maybe options is the way to go. Yeah. For traders, you can buy an option, like I gave an example. But remember, when you sell an option, the downside is unlimited, as in the risk is unlimited. So there are people who sell a lot of sell options and say that, oh, where's it going to 83? And you just keep receiving premium and you keep having a good run and making 6% collecting. But when it goes wrong, it really goes wrong. So you've got to be aware of the fact that selling options is very risky. Yeah. Now, how do you decide on how to take the trade? There is fundamental analysis, which is demand and supply, the news, rates, rate decisions by the banks, Fed rates, RBI rates. When there is a policy meeting, those are factors to take into account. Inflation, FII flows, any big IPO coming in. These are all fundamental news items that affect the demand and supply and affect the rates. While technical analysis is more looking at charts where the price discounts everything. That's what the technical analyst thinks, is the price has everything in it factored, and all we need to do is read chart patterns. Now, my last thing is I will get to just looking at dollar rupee monthly chart. And if you see that this is the way dollar rupee has looked for the last 8 months or 9 months, I have drawn 2 lines here. The red line is the resistance, which is around 80 to 83. And on the downside, I've drawn a support line, which is around 81.50. At the beginning of this month, we saw about 81.60 low. It was threatening to break that. But look where we are today. And it's just in the matter of 1 month. So now we're threatening to break on the upside. So the volatility, the movement is there. Traders will be able to benefit from. We love volatility, right? Because you can make your money there and go out. But for the purpose of hedging more medium term for corporates, it would be good to keep these 2 boundaries in mind, that if we break this 83 level, for whatever reason, we could very quickly be in uncharted territories and seeing new highs, where, again, you'll need to read them, maybe 84. And on the other side, because it's uncharted territory, but on the other side, if we break below 81.50, which is this low, then the next support comes in around 80, 88, below 81. So these are levels to keep in mind, because when they break, everyone, like if I'm an exporter and I've sold around here, if we break around these levels, there might be a lot of stop losses going. While if there's an import and you haven't hedged and we suddenly break this, because that's the level that the authority or regulator has been defending, you might say, oh, now I don't know where it's going to go. We don't want to become like last year from a 75 to an 82. Let's just, hedge it. So you see here, which is around last year, March, we were around last year, yeah, somewhere around here, 75, 76, and we've seen such a big movement. This is monthly, yeah, around here. And now this is the last 7-8 months, yeah. And this is the same chart, but a shorter time frame, the same chart in a weekly time frame. So you can see during the week how the movement's happening. This is in the matter of 2 or 3 weeks. And traders will probably take advantage. For those who are trading, you want to look at small, shorter time frame chart. So maybe the max you will look at is daily, and look at 2 hourly, 30 minutes, 15 minutes, 5 minutes, depending on what your time frame is. I'm happy to take any more questions. And I think maybe I'll just pass it back to Ramesh so that somebody from the ICICI team can show you guys how the charts look on their system. Yeah.
Sure, ma'am. Thanks for that simple presentation and highlighting on that fundamental and technical analysis or the news that one should look at. I am my colleague, Arvind. Arvind, if at all you can just quickly show how a customer or how a corporate can place his order through our charts.
Sure. Thank you, sir. Thank you so much. Dear viewers, hi all. And I believe Ms. Sapna had given you really valuable insights on whether you have to go ahead with Forex risk management, if it is required for you, and how to analyze, make the quantitative analysis for that also. I really believe that has helped you and you will make the right decision. And before that, also Mr. Vivek had explained you some product specifications, like what are the lot sizes. USD-INR lot size is like 1000, GBP is also 1000, JPY-INR is 100,000. So given all this knowledge, so towards the end, now we need execution, right? So coming to the execution part of it, where do we take you? I'll just show you my screen. Where do we look at the charts, how to place the orders, and based on your analysis, based on how much hedging you want to do. So now this is the ICICIdirect's login section. This is my account where I've logged in. So if you look at it here, there is my watch list, something called my watch list. This is where we have our charts visible. So here in this watch list, you will be able to add all your whatever scripts you want to add. Let's say USD-INR, Euro-INR. You can add your scripts right here. You can just search for the contract, specific contract. Let's say USD-INR 29th May is the monthly contract. Now we can say to USD-INR 26th May, which is the weekly contract. Weekly contracts in currencies expire on Fridays. Every Friday, currency weekly contracts expire. Since today is a Friday, you can see one expiry for today. And you can see 29th May, which is the monthly expiry contract. So you can just click on the chart here, and the chart will get loaded on the right side. You can just see the right side here. So so based on looking at this chart, you can make any your analysis. There are also technical analysis tools available here using which you can make your analysis. And here towards the right, you can see this black price indicator moving and a small plus symbol there. So you can just click at any required price. Let's say 82.65 you'd want to trade at. You expect this price, and you can just click on it, and you can directly place a trade from here. Okay, so this is one possibility where you can try and place a trade. Also of course from the currency. So this is where you can place the trade using using our charts, but of course you can place trades using the currency pages also, where there is a place order section here. So even from here you can do the direct trades. So this is one thing I wanted to explain you. And obviously for you to make the proper decisions, to help you with the decisions, there is something called I click to gain. If you open the main section and press it here, you'll be able to look at this I click to gain part here under the sub menu. So you can just click on this, and you can go to the section where you have trade recommendations. At ICICIdirect, we have our own research team, in-house team, Ms. Sapna ma'am towards the end was mentioning about some fundamental analysis, like what are the inflows and outflows, what are the trade balances, what are the life happenings in different countries, what are all the interest rate fluctuations. So all those fundamental analysis and news, market news, forex market news are being analyzed regularly by our research team, and we provide research calls. We provide our views on where dollar moves or pound moves or where euro moves. It's going up or down. So we give our research recommendations also here. From here, you'll be able to directly take these recommendations and go ahead with your positions. So this is one more thing that I wanted to show you. Additionally, along with this, there is something else I wanted to show you, which is the for the research reports. You have seen the trade recommendations here, but you'd also want to look at the research reports, right, on a regular basis, like daily market update. For example, every day in the morning you get a research report. What is the view for today? What is the dollar view for today? Right? And every Monday, that is weekly reports also you get, monthly reports also you get. So for all that, if you need updates on that, just take a snapshot of the screen, or you can just scan scan this code, so that you can just join in our Telegram channel, where you get daily updates, daily reports. What is the view for that day, particular day? You will be able to look at it here. And quickly, after this, this I wanted to mention, at the beginning of the webinar, Mr. Vivek had mentioned some difference between equity and currency derivatives trading, costing between these two derivatives. So what are the costs exactly applicable? But going ahead, I'll just quickly give you simple differentiation between these two products, equities and currencies. In equities, you'll have a number of scripts, hundreds of scripts, lots of stocks and shares to trade with. You will not be able to
Yeah, I think Arvind, we lost your voice and also the presentation. So Arvind was just highlighting the difference between equity derivatives and currency derivatives.
Ramesh, 1 second. I just for all the traders who are here, I mean, I've just seen what he said about putting the order and executing a trade, whether it is selling or buying. What you might want to keep in mind, because currency markets are very, very swift as compared to equity markets. The moment you put a trade in, it would be best advised to also put your stop loss. It is possible to put a stop loss order immediately, and as well as TP order, so if both are in the system and you even go to the, to have a glass of water, if the levels come, they'll just get executed, because otherwise you've blinked and you've gone to take a call and it's somewhere else only, the currency. So it might just make sense to, put stop loss orders and TP orders as well.
Great. So Arvind actually got disconnected. That's fine. So he was just explaining the difference between equity derivatives and currency derivatives. So obviously, Vivek did answer about it. Liquidity is great, right? Transparent pricing, and most important is timing for corporate, especially after 3:30. It's a little difficult for the SMEs, MSMEs, and smaller corporates to hedge on the OTC platform. But here you have a platform where you can hedge till 5 o'clock. And Vivek also did mention about it. It's not just for SME or MSME, it's for large corporate also. Like one can hedge from few $1,000s to 889 million, right? And up to 100 million, no questions asked. It's only beyond 100 million that one has to give undertaking and then hedge. So these are the things what my colleague wanted to highlight. And also about ICICIdirect, it's a robust risk management system that we have, right? Obviously, a bank broker. We come out with research reports, we keep helping, we keep recommending on clients, and above all, we keep doing these kind of webinars. We want our customers to understand, know how the markets work, and then come and hedge or trade on this platform. So I know we have run out of time. We thought of 1 hour, but we have 1 hour, 15 minutes now. I just want to take 1 or 2 questions if there are. 1 second. There was one question which said that we have a natural hedge, but our import and export timing doesn't match. But I think ma'am answered about it on the natural hedge. Okay, any other questions? I'll just take a minute, and then if not, what time frame is good for intraday trade of currency segment? So
intraday currency segment, I think you should be looking at half an hour, 15 minutes, half an hour hourly, those charts, because If it's intraday, you're probably looking at making, if you make 5 or 6 paisa, that's great, because when it moves, but most states it's about 10, 12 paisa. So if you can get 4, 5 paisa, that's great. So I think
you're looking at intraday, you're saying 15 to 30 minutes, 15 minutes.
I think, yeah, 15 minutes, 30 minutes hourly, that's the maximum charge. Anything less than that, you'll be like 5 minutes, it'll be very whippy. So a lot of times you'll feel that you're just getting stopped and, getting, there's more trades, but there's not enough money. Less than that.
Yeah. I think the next question is also from a trader. I don't have huge capital with me for margins. Should I prefer option buying for trading?
To be honest, that really depends on your risk appetite and your view. So with options, you see if it's a sideways market, you're really going to just lose out on options. As in, if you bought an option, but if you did get the view right and it went one way, then options, if you bought an option, you would really benefit out of this. So it really depends on the volatility that's there in the market right now. At this point in time, it's very, very low volatility. So people buying options may not be the way right now. But if it breaks 83 or 83 and we start moving, and it gets very volatile, then maybe options might be the way.
Yeah, I'll take the next question. There's one question from GC Singh. Can't we place order on chart? Yeah, we can. Arvind just calmed off, but I think, one can place orders from chart. And as ma'am said, you can put a target and also a stop loss. Right. Ma'am, I think we have exceeded the time. I think it's 1 hour 18 minutes. We have a lot of participants here and many of those questions I'll just reply back on the YouTube live chat once this session is over. But thank you so very much for consenting, and
Thanks.
I'm sure our corporates will benefit from this webinar. Right?
Thank you.
Thank you.
Everyone. Bye.
Thank you.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.